about inflation and growth. With me, Kevin Lings, Chief Economist at Standard. Thanks very much for coming in. And Mamelo Matlinga from the Macroeconomic Analyst at FNB. Thank you very much for talking to us. I want to start with you, Kevin. How do you describe this announcement or this address this afternoon? Was it dovish, was it hawkish, or a mix of both?
I think it was a little bit more dovish than we had at the last MPC meeting. Remember last meeting they were warning about the possibility still of an interest rate hike. They'd revised up the inflation forecast. They were still worried about a range of factors, including food inflation, petrol inflation. This time around, they seem a little bit more sanguine. I would say a little bit more concerned about obviously what the currency is doing, but in general, revising down their inflation forecast quite meaningfully. Obviously, their growth number is still fairly weak, although they did revise it a little bit. So clearly still concerned about growth, but a little bit more comfortable on the inflation outlook. And so they're edging closer to this idea that they could well cut interest rates later this year. I think that's still a possibility.
It's very interesting, though, Mamelo, that this 3 days of meetings and decision-making this week was done amid a climate of a rather tumultuous climate, such political uncertainty. We've seen the Reserve Bank governor making reference to it. What do you think they were thinking while considering what to do with interest rates as the events around the finance minister unfolded? Because it had an effect on the key component of inflation, which is the rand.
Definitely. I think, a week ago when we were sitting and looking at the rand, we saw it sustainably below 13. And then come Monday, the rand depreciated quite significantly. Yep. And I think at the events of Monday not unfolded, I think the tone in the statement would have been significantly different. And it's very unfortunate that they're dealing with this very uncertain political climate, which could turn very quickly, as we're seeing right now. As I said, we're below 13, and we're trading around 13 with potential to go even weaker should the situation worsen. And I think once there's a little bit of clarity, if any, as the months progress, we will see a change in terms of how they approach the inflation numbers. I think, as Kevin rightly mentioned, that the statement does sound a tad dovish, but unfortunately they are quite restricted by this uncertain political climate. See,
sorry to interrupt, I don't think they want to get caught into an expectation of an interest rate cut and then find that the political turmoil intensifies and the rand weakens even further. And let's say that the rand is now 13.50, approaching 14 rand, and suddenly the inflation outlook changes very materially. And then they've been messaging that they're about to cut interest rates. So my sense is there's a cautious tone to some of their statements. Overall, they're a little bit more comfortable, but they don't want to get people too fixated on the idea that an interest rate cut is an automatic guarantee later this year.
And he does say, though, Melo, that it is the currency value and the forecast of that's probably the biggest upside risk to inflation, doesn't he?
Definitely. And I think we've also had to adjust our numbers quite significantly following the depreciation in the rand. And I think, they will just have to wait and see whether there is a change in the currency. And right now it's very difficult to predict. I mean, there's a number of analysts that are coming out saying that they see the rand going to 15.50. And if we are operating in that environment, then clearly there's absolutely no chance of interest rate cuts anytime soon.
You were speaking about interest rate cuts earlier, Kevin. He does say, though, that we have reached the end of the hiking cycle, with a caution.
Yeah, I think the caution is if, as you say, if the rand does continue to weaken and suddenly inflation looks like it's going back above the target, or meaningfully above the target, then he may well respond by hiking rates as a way to try and defend the exchange rate and perhaps try to get inflation back inside the target again. So you can't rule it out entirely. But as things stand at the moment, based on the best assumptions he's got, you would expect that this is the top of the rate cycle for the moment, and that the next move should be a cut in rates. But you've got to be cautious about when you time that. And it may well take a little bit longer than what was anticipated literally a week ago or 2 weeks ago.
Mamelo, what do you make of the slightly improved projection on growth? From 1.1% for 2017, it's now got it at 1.2%.
Look, it's neither here or there. I mean, 1.2%, 1.1 really doesn't make much of a difference. I think he highlights that, confidence is still very weak because of the uncertain economic climate, and we definitely see it in the business confidence index. And if you look at that index relative to how private sector fixed investment performs, they almost trend together. So we certainly need to see an improvement in business confidence and a pickup in gross fixed capital formation. They still have it as negative for this year, and so do we. I wouldn't read too much into a percentage increase. In fact, at the end of the statement, he highlights that risks to the growth outlook are significantly to the downside, especially if the political climate does not improve. It's going to weigh on investment, and it's going to weigh on household consumption expenditure, and we share the same sentiment. I mean, I wouldn't read too much into a marginal improvement in the GDP numbers. I think they're still very weak.
And that's so important for jobs, isn't it, Kevin? I mean, he's put down the fact that people are just not investing. Businesses are not investing. If that doesn't happen, you won't get the jobs.
That's right. So business investment is in a deep recession. I would say it's actually at a point of being in a state of depression.
Yeah.
Business has almost withdrawn from this economy in terms of wanting to expand or put more capital. They haven't left the country. They're still operating. They're still making good money. Their profits are good. Their cash on hand is good. But what they're not willing to do is expand capacity and employ. And obviously without employment, you just can't get sustainable pickup in growth.
Yeah.
The one thing that I would want to just flag here is that, we have to acknowledge that there's a nice move coming through on the oil price, and that's pushing down the petrol price. And we've got the fuel levy increase coming through next month and the road accident fund of 39 cents. Yet the petrol price should come down next month 20 to 25 cents. And I think that one of the benefits that we see now in terms of the inflation outlook, and possibly a little bit in terms of growth, is the fact that the oil price has come down, and it may well languish at this level for a while longer, around $50 per barrel, and so that provides us with a little bit of relief in this environment. Yes. So it's not as if it's all bad news at this stage. There are one or two factors that are helping us, but obviously the currency becomes now the overriding short-term indicator. And I would imagine that as we project forward to the next MPC meeting, we've got to factor in just how much political stability is likely to be, how much currency stability, as you try and forecast those interest rates. To get comfortable on your interest rate forecast, you're going to have to get comfortable on your political outlook, unfortunately.
Mm-hmm. Do you think we can start paying less attention to the effects of drought now on inflation?
Yes, definitely. I think if we look at your grain prices specifically and how that component has performed over the past 2 months, if you look at grains, you look at vegetables and so on, we saw that contract for the first time in year-on-year terms. This is vegetables. And if we look at grain prices, those are starting to increase quite significantly. But the caveat to all of this would be meat prices, and they flag it again in the statement, and they did in January. So if you look at the movements between grain and meat prices, is that your meat prices are starting to increase because the effects of the drought on meat prices ultimately resulted in farmers culling their herds and then pushing supply of meat into the market, which resulted in meat prices that declined somewhat. And they are in this period of rebuilding stock, meaning that meat prices are going to stay elevated for quite some time. So the drought effect when it comes to grains and vegetable prices and so on, I would say that's behind us, but meat prices still remain relatively sticky.
How long do you think we'll have that component or that risk there, Kevin?
In terms of
the meat prices?
Meat prices, probably for all of this, it takes a while to rebuild herds. It can take actually, 2 years to try and get the herd back up again. So I think we're going to have it as a risk. But I think overall, I'm comfortable with the idea that food inflation does moderate into single digits, probably around about the 6-7% during the course of this year. And I think that's enough for the Reserve Bank to feel comfortable with where food inflation is going. And then next year, I do expect another moderation, assuming a reasonable agricultural season.
All right, let's get a little bit more analysis after the break. And when we come back, we'll talk more about what the rand and inflation, as well as the growth prospects are for the country. Stay with us.